All right, thank you everybody for joining us today for our webinar, where we will be bringing together some of Altus Group's CRE valuation experts to weigh in on the results of our Q2 2024 CRE Industry Conditions and Sentiment Survey. My name is Cole Perry. I'm Associate Director of Research here at Altus Group, and I'll be moderating the discussion. So for those who are not aware, the ICSS survey is a quarterly questionnaire that we send to CRE industry professionals, like many on this call, to get their sentiments on a wide range of topics within the landscape of CRE. You can access the US and Canadian results by clicking the link that'll be available shortly in the GoToWebinar platform chat. I did want to mention before we get started that the Q3 industry survey opened yesterday. It's now taking responses. I've already seen some good numbers, but we have a lot of attendees here on the call, so hope to see some of you respond to that. We'd appreciate your perspectives on some of these topics we discussed today. And again, that link is also going to be found in the chat. For today's discussion, we're focusing on the topic of valuation and whether the survey results line up with what some of our experts in the field are seeing. And so with that, I want to introduce you to some of the folks we've got here on the call today. To do that, so we've got a great panel. Alex Jaffe is Senior Director of Advisory located in our Irvine, California office. Rob Tafaro is Senior Director of Advisory coming to us from Chicago. And Rob Santilli is Director of Advisory in Halifax for a bit of Canadian perspective. As I mentioned, I'm Cole Perry. I work extensively with the ICSS survey in the US and Canada, and I'm hoping to bring some color and perspective from that point of view. So I want to note that we do have two Robs on the call, so to keep confusion to a minimum, I'll be referring to them as Rob T and Rob S, if that works. So we'll go ahead and go through a little bit of housekeeping here. This webinar will be recorded. Everyone who registered will be sent a copy of the recording following the webinar. There will also be a couple of poll questions along the way. So we encourage you to answer those because we want to get your thoughts on some of these topics as well. I think we want to see if they line up with some of the things we found in the survey. So if you have any questions over the course of the webinar, please enter them in the chat function. If time permits at the end of the discussion, we'll get to those. And if we don't, we will definitely get back to you afterward. So without further ado, I would like to go ahead and jump right in. I'm going to stop sharing my screen here for just a moment. But one of the things that I want to start off with to set the stage for our discussion is, do we think that we've reached the commercial real estate valuation bottom? So I'm going to kick this off by turning it to Rob Tafaro. What are you hearing from clients? What do you think is kind of where do you think we are in the environment?
Yeah, thanks, Cole. You're kind of jumping right in with that tough question here. From my perspective in the US, we appear to be getting close to an inflection point when looking at capital market assumptions. Over the last 12 to 18 months, cap rates have expanded materially and valuations are generally supported by recent transactions in the market. I'd say based on the sales we track through our clients' portfolios, recent transactions are relatively close to the most recent appraised value, which are typically on a quarterly basis. Additionally, interest rates appear to have stabilized and investors are waiting for rate cuts from the Fed, although they haven't come quickly, I think, as many of us have hoped. That said, the exception really remains is traditional office. There's still a large bid-ask gap between buyers and sellers, indicating there's more pricing discovery to come. However, from a fundamentals perspective, there are definitely some pockets of softening in certain sectors and markets as the industry deals with some short-term oversupply. The general consensus is that we'll get through this in the near term and real estate will be poised for strong NOI growth in the next year or so, just given that new construction starts have materially decreased. So just to summarize, it does seem that capital market assumptions have stabilized, again, with the exception of traditional office. However, there's definitely some concern regarding fundamentals, so we'll kind of just have to see how that plays out in the next 6 to 12 months.
Alex, you're based here in the States as well. Do you agree with Rob? What are you hearing?
So I would echo what Rob said. So not to repeat, but maybe just a slightly different lens. Short term, as Rob said, we think we're at an inflection point for the asset classes where the fundamentals are stable. Medium to long term, I think the sentiment is overwhelmingly positive. And the reason we're seeing that is because there's restricted supply. So if you think about 2 years, 5 years out, if there's less supply, that should be accretive for those owning those assets going forward. And then the other consideration, as Rob mentioned, is if we do anticipate interest rates to decline, that should also be a tailwind for the asset owners medium to long term. So I think short term, as Rob mentioned, we think we're at an inflection point, but really medium to long. I think most investors are very positive. And the thing that we saw coming out of the GFC in 2008, 2009 is a question of when to re-enter the market. And that happened very quickly, call it 2009, 2010, meaning the trades and transactions got very crowded. And so when we're speaking with a number of advisors or owners, it seems like the discussion is really around when do we enter the market? Do we enter now? Do we try and get ahead? Or if we wait too long, will it get too crowded? And it feels like we're having that same discussion overlapping with almost every advisor we work with.
And Rob Santilli, what about you in Canada?
Thanks, Cole. Hey, everyone. So what we've seen over the last several quarters, based on discussions with clients and other groups, it does feel like a bottom is in sight. That being said, the majority groups that we speak with do believe that there is some more room for office values to move lower, so similar as the US. Going forward, I would expect that any value declines for office are going to be more situational, asset specific, and show a separation between strong assets and struggling assets. Market-wise, within Canada, Calgary office fundamentals are improving. So as we know, Calgary has been challenged for the last 10 years, and valuations have come off significantly during that time. However, in the past quarter, we did see some office values in Calgary move higher, which did buck the trend of other office markets. For the other asset classes, there are still buyers, and it's generally a tighter bid-ask spread than what we're seeing in office, which is why I say that there could be a bottom in sight for those types. Nonetheless, there are still some headwinds, although fundamentals are mostly still favorable to owners. However, there are some pending transactions that, if they go through, could point to a little bit more cap rate expansion. So interestingly, the conditions and sentiment survey had an increase in percentage of Canadian respondents that felt that multi-res was overpriced. So contrasting Canada to the US, we don't have the same supply coming online in any category, but we also haven't seen the same price adjustments that the US has experienced.
Yeah, and we'll get to some of those points in a later slide here, but thank you guys for shedding some light on that. Let me bring the slides back up. We've got some good topics to get to here. All right. So we're going to jump right in here with current focus. So in the Q2 survey results, we saw that 40% of US respondents and 50% of Canadian respondents said their primary focus would be managing the existing portfolio or exposure. And this was fairly flat and virtually no change quarter on quarter for both countries. And so I'm going to turn this over to Rob first, Rob S. In Canada. So do you think this might have changed if there was, if the survey had been completed after the Bank of Canada dropped rates on June 5th?
Yeah, thanks, Cole. So I'm not surprised by the responses. Improving operations is the focus now for many clients. One client that I spoke with called it a basis point game, with asset management and property management really being in focus. And as cap rates have moved higher, getting the most out of your property, driving NOI, lowering expenses, and getting creative has become imperative. So regarding the Bank of Canada move in June, at the time that was widely expected, whether it was going to be June or July. And as we know, the pace and degree of interest rate cuts has slowed dramatically from where we stood at Q4 2023. but the most recent cut does indicate to the market that we've moved from a period of increasing rates to holding rates. Now it looks like into one of lowering rates. So I think that generally the Canadian markets are expecting another cut before the end of the year. So this is going to spur more deal activity. And certainly there are some groups that want to get in and ride another cap rate cycle lower. So I think many institutions have already started to move back into acquisition mode, but nonetheless, I think it's still going to remain an environment where you're focusing on operations and improvement.
And Rob Tafaro, what do you think about from a U.S. perspective? Are your U.S. clients thinking the same thing?
Yeah, I think that's pretty similar to what Rob asked said in Canada as in the U.S. Obviously, with transaction volume suppressed, clients have naturally shifted resources to portfolio strategy and a focus on asset management. This means optimizing NOI and managing expenses. I think clients want their portfolio to be in a position to overperform once the market recovers and transactions pick up to a more normalized level. As Alex mentioned on the previous question, once clients are kind of ready to jump back in the market, they want their assets to kind of be ready to perform.
Yeah, absolutely. I wanted to step back a little bit because I think these results are really interesting to me from a different perspective. In the US, one of the biggest changes from the fourth quarter to the first was actually the percentage of respondents who told us they'd be deploying capital. So that jumped in the first quarter from 7% to 25%. And so I think what's super interesting about the Q2 survey is that this only ticked down slightly to 20%. But again, well above those Q4 figures. So my sense of that is that there was a lot of optimism kind of coming into the year about a potential 2024 interest rate cut. Alex, do you think that this is something that's been a source of optimism from your clients? Are they planning to transact? What do you think?
Yep. So I would say, Cole, and we get this question a lot, especially today with lower inflation news, but it's positive for real estate, is, if the Fed cuts rates, what happens? What does that mean for one rate cut, 6 rate cuts, et cetera? I think what we would say is take a step back and say it's more about the overall sentiment or really the longer term borrowing cost. Yes, the Federal Reserve sets certain rates, but it's really a function of what is the debt market and what are those costs to borrow, and then what that implies for your return to the asset. But that being said, I think the sentiment is increasingly positive for commercial real estate. Again, we will carve out traditional office as slightly separate, but the other sectors seem positive. And again, I think, the more and more prints we see out of the news, the more positive transaction activity we see with large portfolios. Number of the private equity firms have transacted the past couple months. We feel like the sentiment is positive. And then we've also seen the credit markets tighten slightly. So that's also been adding to the positive sentiment overall. So I think that's really a function of the change in the attitude or environment from Q4 to Q1, not so much when exactly is that rate cut coming.
Understood. So let's hop right into transaction activity then. I think everybody touched on that in their previous answer. We're going to launch a poll here. So I'm going to change my slide. And what we're going to do is ask you guys to respond to the question of, over these next 6 months, do you anticipate, meaning you attendees, do you anticipate any transactions in your portfolio? So you've got 4 choices. These are going to be yes, you're planning on acquiring or buying. Yes, you will divest or sell. Yes, doing a little bit of both. Or no, managing existing exposure, not planning to transact in the next 6 months. So we'll give folks a minute there, and we'll see if some of these answers here reflect what we heard in the survey. All right, I think we can go ahead and close that poll. Let's see what the results are here. So it looks like around a third of our respondents plan to be buying and selling. Looks like about a quarter saying they're going to be acquiring. A smaller but significant percentage say they will be divesting. But really interesting is that 27% are telling us they are going to likely not transact. So I think that's really interesting. So I think, so thank you guys for responding to that. I definitely want to get some reactions here, but let's go ahead and hop over to the results from our actual survey here. So looking at the actual results, the majority of US respondents said they planned to do some form of transaction in the next 6 months. So compare this to our question that we just polled. And this is a combination. This is folks who, the percentage who told us they would be buying, selling in total, so irrespective of if you were going to do both. So if 27% said they weren't going to transact at all, I think this matches up pretty squarely with what we see here in the results. 65% in Canada said they plan to do any transaction in the next 6 months. That was down a little bit from the previous quarter, which showed 71%, but in the US, that figure is 80. And so you see that that's from all responses, and it actually has a nice step ladder or stair step function, depending on how large of a firm you are. So I want to turn it back over to our panelists. Is this what you're hearing from clients? I'll give that to Alex first. I know you touched on transaction activity a little before, but what are you hearing?
Yeah, thanks, Cole. So we've heard a camp of either clients or maybe headlines in the news that said there's a significant amount of distress, or there will be opportunities to make significant purchases at 20 cents on the dollar, 40 cents on the dollar. To be honest, we haven't seen it in most of the core portfolios we work with. There certainly are pockets, or there certainly are unique considerations or assets, but we haven't seen wide sale distress. And so I think the transaction activity has not reflected that like we saw in 2009, 2010. What we have seen is for the large core portfolios, we've seen sort of reshaping of their allocations, whether that's by sector, whether that's by geography. We've seen some niche sectors increase allocations, which we'll talk to, I know later. Cole will get to that. So we've seen some movement on the edges, but we really haven't seen sort of fire sale or wholesale changes. And I think that's really one of the benefits to a large core portfolio, right? You think about how much values or how much the market has changed 2019, pre-pandemic to the pandemic and coming out of the pandemic to now. And most of these portfolios have been relatively steady. And so I think that's, again, speaks to one of the benefits for having a diversified mix of assets, is that you don't have to reshape the entire investment thesis.
Absolutely. And what about you, Rob T? What you're also in the U.S. Is that consistent with what you're hearing?
Yeah, it's pretty consistent. I'd also say, I think Alex mentioned earlier, there's it's just become more positive around transaction intentions. So I think now that interest rates have stabilized a bit with the expectations of potential rate decreases on the horizon, investors are just generally more comfortable about underwriting deals with leverage. And then just the last thing I'd say, we're definitely hearing there's more buyers bidding on the transactions that have been happening in the last quarter or so, especially for industrial and multifamily. So that's really obviously a positive sign. It just shows there's more buyer interest and people or funds willing to get their feet wet.
So Rob S., I'm going to turn this back to you now for a bit of Canadian perspective. What are you hearing from some of those institutions?
Yeah, so a lot of the sellers of the last 2 years have been institutions, and I do expect that to continue, but we also are starting to see them looking to buy again. So the closing of bid-ask spreads, stabilization in prices should result in more transactions for the balance of 2024. The groups that we work with overall, I would say, could move from net sellers to net acquirers in the coming quarters. So currently they're churning their portfolios, reducing exposure to office, or trying to reduce exposure to office, and then taking advantage of opportunities to high grade their portfolios. But overall, I would expect that I'm to see more transaction activity in the second half of the year.
Excellent. So I want to add a little bit more color to this. And Rob, as you just mentioned, pricing. So there was another question that we asked in the survey here on how you would characterize current pricing for most of the major property types. And so I want to shed a little bit more light on this. Really interesting that most of the sectors are broadly viewed to be overpriced. So 72% say so for land and development. I'm focusing on the US results for a minute here, but 67 for life science, 61% for multi, 60% flat for hospitality, 56 for office. But on the flip side, 56% tell us that single family rentals are fairly priced. 57% say so about industrial. And then there's a bit of a standout property type here. 83% of respondents to the survey in the US told us that retail was fairly priced. So I'm going to turn this to Alex. What kind of transactions do you expect to actually get done when the sentiment around pricing looks like this? What are you hearing from some of your clients about the types of assets that they might be willing to do transactions for?
Yep. So Cole, we are hearing all buyers want significant discounts to where they either think the value is or where they think they can negotiate on the value. But most of the sellers, while they're willing to potentially accept slightly lower prices, they're not willing to meet exactly where the bids are coming in. And the other interesting thing we've started to see, and again, just to emphasize what Rob said earlier, is we are seeing more bid activity. And so the ability to negotiate a 30, 40x% discount is not as obtainable as it was, I would say 3-6 months ago, because it's much more competitive. And just to be clear, we are seeing transaction activity in all sectors, all products. We're definitely seeing it in office as well, which probably has the biggest adjustment to value, but it's as if the buyers want this large discount, but because it's more competitive and the sellers are not forced to sell, we're not seeing quite as significant discount as some people are expecting.
So I think
to the survey results, Cole.
Yeah, excellent. So I think this is a good segue into our next poll question. And this is, again, one of the topics we asked on the survey. So we'll talk next about property type performance. So office has been mentioned, multi-family has been mentioned. But the next question we've got here is, how do you think property types will perform over the next year? So pick whichever category you think or sector you think will perform best. We have kind of the big four main property types, or the major food groups: office, residential. You can think about that as being lumped together with senior housing or single family rentals, as well as multifamily, retail, and industrial. And then non-traditional sectors. So we do break these out in the survey, but for the sake of the webinar here, we're going to lump them together. So non-traditional sectors meaning self-storage, data centers, land, a couple others as well. So give folks a minute to fill that out, and we will see what we've got. All right. I think we can go ahead and close that. So it looks like a lot of different opinions here. Not very many of the respondents to the poll here believe that office is going to be performing best. Around a third say it's going to be residential. And almost as many actually say non-traditional sectors. I'm not super surprised to see that, noting some of the news about data centers. Industrial at about a quarter of respondents, and retail a little bit lower at 14%. That actually is quite interesting. So let's pull up the results from the survey. We asked folks to explain this a little bit differently. So the structure of the survey question is we ask folks to bucket property types into whether they think they will perform best or worst. So you could not actually place the same category in one. You also did not have to put in all of the property types into one or the other. So the question really captures the extremes. And so I want you guys to react to some of those responses from the poll and to what we're seeing here. I'm going to turn it to Rob T first. I know you've mentioned some about niche sectors in the past in the US. Tell us what you're thinking about property type performance or what your clients are thinking about.
Yeah, so I think what we're seeing is consistent with both the survey and the poll result we just ran. So we're definitely seeing a shift away from traditional office and some other sectors and increased investor appetite for alternative or niche sectors. These sectors offer additional diversification benefits as well as attractive risk-adjusted returns. I'd say, in addition to strong conviction for industrial and multifamily, some sectors like self-storage, senior housing, and student housing rank towards the top of the list for projected performers in the survey. And just an example, a story that was in the news recently, CalPERS is looking to deploy more capital in non-core real estate. And as part of this, the pension fund recently committed $100 million as an anchor to Nuvine's Core Plus Open-End Fund, which is going to target primarily affordable housing. And then just lastly in the US, did want to mention that NCRE recently went through the process of reclassifying those niche sectors, kind of to clarify and separate them out from the traditional sectors. And so I think just this shows additional increased investor demand for transparency and reporting around those sectors so they can track performance just broken out from the traditional ones.
Yeah, absolutely. I know we even had a little bit of a debate on how to phrase that question based on some of the sectors that people are interested in. So Alex, I know you've been talking about retail recently. What are you seeing in that sector?
Yeah, so I would say, Cole, prior to your survey results, which it's showing up as maybe the second best performing, it seems like retail was the sleeper sector for the past 12 months. And I think it's really outperformed the other core property types. And it doesn't seem to get the attention of data centers, student housing, amongst some of the other product types. So, I think that's good to see retail doing well. We continue to see it perform. But the big if is if the consumer slows down and if they stop spending, what does that mean for retail? But we haven't seen that yet.
Yeah, I definitely have to agree with you. I think it's a sleeper sector kind of in my mind as well. We had a lot of respondents telling us that it would actually be the best performing property type. But again, strength of the consumer is the big if. I know that there are some retail sectors that I think are expected to do well, kind of despite perhaps weakening consumer environment. So grocery anchored being one of them. So something I did find interesting in the results here were improved expectations on net for various residential sectors across both the US and Canada. So I think that probably speaks to housing crisis that is slated to grip the US and is probably already gripping Canada. But I think some of these results are driven a little bit by kind of media expectations as well, and some of the conversations around the CRE CLO market and the oncoming wave of supply. But before I keep talking, I research this stuff all the time. I do want to turn it over and get a bit of a Canadian perspective. So let me advance slide here to show the results for Canada. And Rob S., I'm going to ask you to react to these a little bit. What sectors are you seeing or expecting to what are your clients expecting to be the best performers, or what are you hearing?
Yeah, so I agree with Alex that retail doesn't get the same attention as industrial and multifamily. That's because it doesn't have the same headline grabbing fundamentals, good or bad, depending on if you're a tenant or an owner. But then, of course, Cole, like you said, not all retail is the same. So that's true within any asset class where we've seen the divergence in performance between the strong assets and the not as strong assets. So I'll throw in a little plug here. So Altus completes a quarterly survey for Canadian market participants, Those Canadians on the call would know it as the Investment Trends Survey. So in that survey, the most recent quarterly results, grocery anchored retail ranked as the highest sought after investment type, so a subcategory of retail overall. And food retail has showed increasing investor preference over the last several quarters. So it was ranked #1 ahead of single tenant and multi-tenant industrial, which were 2 and 3, and then multifamily, which was in 4th place. And then in that same survey, unsurprisingly, the most negative sentiment and very consistent with what we've got on the screen there. Office is the least sought after investment, with suburban B and downtown B, office being the least attractive for investment. Then downtown A, office, still had negative sentiment, but was much more balanced in terms of groups that would be buyers versus sellers. And then going back to retail, so sentiment for tier 1 retail malls moved from negative territory to positive territory Q2, which I think speaks to the broader retail recovery story. I think while res and industrial get a lot of focus, good retail should continue to perform well.
Excellent. That's some good perspective there on the different sectors in Canada. We're going to make a little bit of a pivot here as we kind of round out one of the other questions here on the survey. We're going to talk about artificial intelligence. So the most recent survey, well, I guess I'll back up a little bit. In Q4, we started asking a question about CRE professionals' expectations or understanding of what artificial intelligence could do to the industry. And so there was one particular response that we allow people to select, and that is to tell us whether they believe AI will be unproven technology with to see if CRE professionals are skeptical of the technology's kind of influence on the industry. So I'm going to turn this to Rob T. What do you think about some of these results? Are you surprised to see a huge drop in kind of tenured CRE professionals telling us that this is unproven technology?
Yeah, I mean, I think the general drop in AI skepticism isn't surprising. You can't really read the news today without finding some reference to the benefit of AI, no matter what the industry. And I think this definitely includes commercial or applies to commercial real estate. Here at Altus, we are working on predictive analytics, big data, AI assist that will hopefully provide additional value to our customers. I'd say additionally, the commercial real estate industry has historically lagged and been slow to adopt technology. So I think given this, AI could potentially even benefit our industry more than others. And then just lastly, I think I'm most excited about is predictive analytics for investment decisions and portfolio strategy. I think this could potentially lead to outperformance, especially for those early adopters who really embrace the technology.
So I'm glad you mentioned that. We have a couple other responses to this particular question. So the other statements folks could agree with was, do you think AI is a threat to the industry? Do you think it will disrupt the industry? Kind of a fairly neutral response. Or do you think it'll have practical benefits? And I think the overwhelming number of respondents in the last couple of quarters, it's been upwards of 75%. Tell us that they think it does have practical benefits for CRE. Around 1 in 5 tell us that it will fully disrupt or transform the industry. And really interestingly, I think 18% in this previous quarter told us that it poses a threat. And I did want to mention that choice was most popular among those with less experience in the industry. So I want to turn it to Rob S. What do you think about AI? Is it going to bring about a revolution in our industry?
Yeah, so I do think that AI is going to be the next great revolution. So it doesn't surprise me that there's decreasing skepticism. AI's become a big investment theme in the poll. Today's poll, it was listed in the other category, which was set to outperform. But AI in general, big investment theme. You can just look at equity markets. Within the real estate space, data centers and the infrastructure to support data centers are attracting a lot of interest. As AI advances, it's certainly going to transform some industries. And that understandably can create some uncertainty. And Paul, you mentioned threats. So I think individuals with less years of experience could be concerned that AI will replace their jobs. but I do like a quote that I've heard. I didn't come up with it, and that's that AI is not going to take your job. Someone using AI is going to take your job. And the same thing applies to industry. Companies need to invest in AI in order to stay competitive.
Absolutely. I think we've parsed these results a couple of different ways, and those folks who, CRE is a relationship-based industry, and I think that nothing is going to be able to replace that, but I think we can enhance some of the tools that we've got with this technology. So I'm certainly excited for it as well. So I think we've got a few minutes here. I'm going to go ahead and turn it back to our audience here. I think we've got a bit of time for some questions. So Alex, I know that you've been monitoring the chat and some of the submissions. Do we have any questions from the audience here?
So we did receive a number of questions, and if we, as a reminder, as Cole mentioned, if we do not get to them, we will follow up directly with you. So bear with us. But I think the first question, and this would be both to Rob T and Rob S, and I'm paraphrasing, but in your view, what do you think is the biggest risk or downside concern for valuations going forward?
Yeah, I can take this one first. I think just to go back to the response to the first question, or my response to the first question, although price and metrics have seemed to stabilize with the exception of traditional office, we've definitely seen some softening in fundamentals. So as I mentioned, generally the softening appears to be due to short-term oversupply, but hopefully will reverse, giving a significant decrease in new starts or new construction. However, I'd say if fundamentals do continue to go sideways, I think all bets are off. So we'll just have to see how that plays out over the next few quarters.
Yeah, I think one of the biggest risks is higher for longer than anticipated interest rates and cost of debt. If we don't see cost of debt come down as anticipated, then there could be a repricing for valuations for sure. And then just to Rob's comment on fundamentals, so I see a risk for base rates rolling over for industrial or residential, and then some capitulation in second tier office space rates.
Another question, and I'm trying to grab as many as I can within one. So I will try and group one or two questions together. Maybe to Rob T, what niche sectors are you seeing? Are you seeing growth? And then as part of that, can you specifically speak to self-storage? I know we talk primarily about the 4 core property types, but just any comments or feedback what you're seeing on self-storage as well. There's a question specific to self-storage.
Yeah, I think as far as for niche sectors, I think the question was what's performed well recently. I'd say student housing is definitely up there. I think all sectors aren't immune to some pricing adjustments, but student housing has seemed to weather the storm as far as still achieving pretty good rent growth going into this next school year here. And then also I'd say data centers, and that's kind of back to previous question, kind of related to AI. And then as far as self-storage specifically, I think there's definitely some challenges with fundamentals. There's some supply, some occupancy issues that kind of need to be sorted through. So I think rent growth will be a little bit muted in the coming quarters.
Okay. And Rob S, are you seeing increased allocation to niche sectors in Canada? Anything different outside of the core 4 property types?
Yeah, so we've had some more conversations with groups around student housing. This has become a little bit more mainstream, but it's not widely institutionalized in Canada. Similarly, self-storage, we just don't have the same supply that you have south of the border. And then also hotels has moved up in investor preference on that on the Altus Investor Trends Survey within Canada.
And we received a question on debt, and I'm paraphrasing here, so apologies. for the individual who asked it, but the question is, do debt maturities or the wall of debt impact how we think about valuations? And I think the longer version of that question is, it seems like every week there's a new print in the Wall Street Journal or Bloomberg that says there's X trillion in debt coming due. How do we think about that, or how do we factor that in as valuation professionals? I'll answer that first, and then welcome Rob and Rob to add any feedback. But most of the core funds we work with, and I'll say specifically in Odyssey in the US, they're 20 to 30% levered. So they really have 70% that's equity. And so yes, there are debt maturities occurring, but it doesn't feel like as much of a ticking time bomb or this wall of maturity that gets a lot of the headline news. So I'd say that's number one. The second thing is a lot of the funds we work with either have lines of credit across the entire fund, or they have refinanced in the past few years. So we don't see, in the institutional funds we work with, we don't see this reset from 3% to 6% or 7% interest rate as quite as imminent as we think some of the news headlines make it seem. So I would say that's what we're seeing. Just in terms of appraisal practice, we are valuing all the properties free and clear of debt, just as a clarification. But some of the other implications about the debt, to be honest, we're not seeing in most of the Odyssey funds we work with or the other core funds that we interact with. But maybe Rob T or Rob S, anything to add from a debt perspective, or how we think about that in terms of valuations?
Yeah, so I would just go back to, I think, actually the first question, which said what's one of the biggest threats to valuations, and debt maturities that then lead to distressed sales where there's a default or there's a need to sell. That would obviously have big implications on valuation. So we do get, recently, I've had a number of questions from different clients about what happens when we start to see distressed sales. What will that mean for valuations? So my thought on that is that distressed sales aren't market until there are lots of them, and then they become the market, in which case we would see that impact on valuations. Defaults would also tighten credit, which would then impact valuations. So that would be the concerns from this debt rollover to higher carry costs, and then how that could flow through to valuations.
Yeah, and I would just add, ultimately, from our appraisal perspective, we're looking at transaction comps to inform our valuations, whether it's cap rates or discount rates. And I think most real estate transactions involve debt, so those should ultimately be reflected in the comps we're using to price the assets. I think just in today's environment, it's very important to make sure we're using recent comps, maybe comps that haven't traded yet, and then also really understanding that comp. Was there assumed debt, something like that.
Okay. And we did receive a number of other questions, specific markets. There were questions about other product types. Medical office popped up. We had a different question on specifically what data are you looking at for transactions. So we will follow up with the individuals on those, and we can send you the data or the color around what we're seeing. But more importantly, Cole, I want to pass back to you and appreciate you having us on the call today.
Yeah, thanks very much. And I really appreciate you guys taking the time out of your schedules to join us on the webinar. So thank you to our audience for joining today's webinar as well. Alex just mentioned, but if you have additional questions or topics you'd like us to cover in the future, I would encourage you to reach out to contact-us at altusgroup.com. We will definitely get back to you with answers as soon as possible. So thank you all for attending, and have a great day.